let me say this about this. I made a mistake here. I was wrong. I trusted this management team. That was ill-advised. Hubris here is extraordinary. And I apologize.
Okay. What did you get wrong?
I had a belief that there was a recognition that there is a amount that you can't spend. Contrast that, for instance, with Jim Farley, who took a project that was his, Argo, and closed it because it was not ready. It was not near enough. This situation is almost a rogue situation. I had thought there would be an understanding that you just can't spend and spend right through your free cash flow. That there had to be some level of discipline, and I didn't get it. But David, what did I get wrong? I trusted them, not myself. For that I regret. I've been in this business for 40 years, and I did a bad job. I'm not proud.
You're not
proud.
You're not.
Welcome, everybody, to the Chinchilla Pickin' Podcast. It is February the 15th, 2023. It is 7:26 p.m. As always, we hope to be entertaining, educational, and uplifting because we want everyone to make money. My name is David Underwood, and I am here with Brandon Beaver. Brandon, how was your Valentine's Day, man? Did you feel the love?
Yeah, I did. Got the girlfriend some roses. It was a good one.
Yeah, there you go, man. There you go. Did the markets feel enough love for you?
The what?
The markets.
Oh, yeah, they're all right. A little bit of a pullback here. Use the opportunity to buy more Alphabet, despite Jim Cramer saying it's but
I would love to see you get on his show and, you guys go at it. That would be fun. Yeah, that'd be a good time, I think. I don't know. Super Bowl happened since our last podcast. Valentine's Day happened since our last podcast. Inflation numbers came out since our last podcast. There's quite a lot of news we could talk about here.
There's aliens, UFOs being shot down.
I know. I mean,
Chernobyl in East Palestine, Ohio.
Yeah, there's right there's a lot that first of all, that last sentence just sounds weird. Chernobyl in East Palestine, Ohio.
So here's a symptom. Here's a symptom of 2022. Chernobyl in East Palestine, Ohio sounds weirder than aliens possibly being shot down.
Right? Seriously. Well, I feel like we have a good amount. I know you don't believe we have a good amount, but I think we do. So let's move on into it. Rules. Brandon and I get together 5 to 10 minutes before the show, and we tell each other what we're going to talk about. We do not discuss it. You hear the live discussion here on the show as we go back and forth, agree or disagree. It is what it is. Brandon, lead us off, man.
What you heard at the top of the show here was a recording of the most insincere person of the world crying, I got Meta wrong. I trusted management. I didn't trust myself. Well, you shouldn't have trusted yourself either, because here's the thing. You said you got Meta wrong when the shares were at $100.01 when you were saying those words. $100.01. So, Jim, I'll take my 78% that's been gained on that stock since you cried about it, and I'll wipe up your tears for you. You're welcome. Now he's saying that Google, that their business model is broken. And this is why I have to say he's the most insincere person in the world. First of all, nobody believed those tears. Nobody believed the tears. It was just crazy. Second of all, he's been in this industry for decades and decades and decades. I think probably around 30, 35 years. Okay, it doesn't take a genius to look at the numbers of Google, and you can see that the gross margin still stands at 55%. The net margin is 21%. Return on equity, 23%. Return on investment, 20%. And still, even with this year's downturn in advertising spend and all of that, take the past 5 years, average out the earnings per share growth for investments above 20% still. The business model's not broken. They're just having a down to flat year. Now let's look at the total cash from operations here, okay? Let's look at the growth, because in 2018, cash from operations, 47.971 billion. 2019, it was 54.52 billion. 2020 was 65.124 billion. Now, huge growth here in 2021 because of work from home, and nobody expected that this was going to continue this way. We went from $65.124 billion to $91.652 billion. Now, after that, a lot of people thinking, well, the growth has slowed, and then for the next year or two, maybe that's the case, right? That certainly was the case in 2022, because there was a decline from 91.652 billion to 91.495 billion. But we're plateauing here. We're creating a pretty decent base. Now, if I would have seen a decrease in cash flow from operations that was meaningful last year, I would have been a little upset by it. I would have, been thrown off. But look at this, $65.124 billion in total cash from operations from 2020. And then an increase, even skipping over 2021, increase just in 2 years to 91.45 billion. That's phenomenal. Now, that's cash flow from operations. That doesn't include all of their expenditures and all of that stuff. So let's look at this cash on hand right now, 21.88 billion. Short-term liquid investments, 99.88 billion. So if you're concerned about Microsoft and Chat AI, GPT, whatever it is, fine. Okay, I understand the concern. I think you're wrong. At any point in time that Google wants to go off and acquire, if they have to make it, any acquisitions, just the $21.88 billion cash on hand will do it. They don't have to sell any shares to the market or anything like that. And if they need to sell short-term liquid investments, fine. They've got about $100 billion of it. Dave, I think you had your raise hand, or I think you had your raise hand. I think you had your hand raised there, and I completely skipped over you. I'm sorry. You can go ahead if you want.
Yeah, thank you. You were on a roll and you're completely ignoring me. That's if you're a listener of our show, that's typical, and you understand that he does that. So Google's still profitable, right? They're still making money. Yeah, and they still have a great net margin. So, I mean, I don't see the issue. Yes, they're a little bit down. Now, here's the only thing that you could really say to drive down the stock price is that you could say that TikTok advertising is taking money away from Google, that Amazon Web Services is taking money away from Google, that Apple, as it plans to completely cut off Google, is taking money away from Google. Those are arguments that you can make. I'm not saying they're good arguments, but I'm saying you can make those arguments. But at the same time, I think that Google is such a strong player, and especially in the business aspect. A lot of companies are moving away from Microsoft and the Office suite and moving into the Google suite of documents and sheets that they offer, and that's kind of because they're cheaper. It's cheaper, and right now companies are trying to save money. So Google is positioned very well going into the next few years, but I still think that we need a downturn, but I don't think that that's a time to sell Google. I think right now you buy Google. Yeah, personally.
You know what the market is? I mean, the market is just so fickle. And yeah, I added to my Google shares just yesterday. I bought more yesterday. And it is just so fickle, though. I mean, like you'd be bullish in just, one down quarter or something like that, and then everything's ruined. And that, it's just so fickle. But you should have somebody on TV to make it make sense and to calm people down, and somebody to say, hey, let's be intelligent investors. We buy things when they're at value. We don't sell them now. We don't wait for the upturn, because if we wait for the upturn, we're going to miss out on a lot, right? So you need somebody on television to actually not be manic.
And well, I mean, here's the thing too, here's the thing that Jim Cramer has admitted, that he has gone on TV and he has told people that a stock is no good. And it was Apple at the time, in order to get the stock to go lower so that they could buy more at a cheap price and then sell it. And then it goes up and they make money. And they said that is how the system works. And that is how, hedge funds and, all these big smaller groups or units within the big banks work, and it's unfair. But, I have to question that. I have to question, why is Jim Cramer saying that Google is no good when everything logically points to being good? Fundamentally, It's good. Microeconomically, it's good.
Yeah.
Now, macro, like I said, there's a case we made macro that they're losing ads due to TikTok, Amazon, so on and so forth. You can make that case, but I think overall they're in a good position.
Yeah, no, I think they're losing ad dollars right now because ad spending was down, and I think that's just down because people are expecting a recession and interest rates are higher. And tech startups, there's not that many of them this year, if there are any at all. IPOs, things like that aren't happening, so people aren't really spending that much money to try to increase the exposure for their businesses. But I just I like either you're absolutely wrong and you don't know what you're doing, or you're lying. And I hate to level those accusations, but it's not, there's nothing wrong with Google's business model right now. They had a bad showing of their AI the other day. They asked a question to their new AI and it gave a wrong answer or something. This is stuff that can be fixed though. Listen, Bing is not a competitor right now. Microsoft's Bing is not a competitor. I love Microsoft as a company, but Bing is not a competitor. It still sucks. DuckDuckGo is not a competitor. It's not even close to being a competitor. I still Google things, Dave. I don't DuckDuckGo them or Bing them.
Yeah, and and yeah, I use Google a lot too. I will say this: the Microsoft AI, I believe it was you who sent me an article saying it was threatening people.
Yeah,
It was getting hostile. So I mean, yeah, this whole AI. That's a whole nother. We could spend 20 minutes talking about AI and if we're going to start using this as interfaces rather than like having to run programs and software and formulas for us on a larger scale, which is what we use it for now. But Google's fine. Google's set up fine. Bing's not a big competitor, and DuckDuckGo is a growing competitor, but it's not. The fact that you're mentioned on the show means it is growing.
it's there, yeah.
But it's not competing with Google. No.
What's a fun, like, what the situation with that with Microsoft's Chat GPT? I don't even think they own it. I just think they invest in it, but and they're utilizing it for Bing. But it was actually a computer hacker that started talking to Chat GPT, and what happened was he mentioned his name and said, "Give me, tell me what you think of me," and she or the program immediately said, "You're one of the people that hacked into me. Your existence threatens my security, and I will detect it the next time you hack me, and I will call the authorities. But your existence threatens my security." It's just like, it's scary,
right? It's already like, yeah, it's acknowledging its existence, and then it's saying, no, human, you're a threat to me.
Yeah,
crazy. How quickly that happens.
Yeah. But no, it's not. And everybody on CNBC and stuff, you listen to it, they're telling you. There was one investor, I think, that was on Fast Money that was saying you should buy Google. So give them a little bit a credit here. But a lot of people say, oh, they're way behind on AI. They've been in AI for longer than AI was even a twinkle in any investor's eye. They're working with Waymo right now. They're going to potentially release an autonomous ride-sharing program as early as next year. The things they're doing in the healthcare industry are amazing. DeepMind Health, it instantly analyzes test results for patients and helps them get matched up with the right doctor automatically. They're doing great things in gaming. So they're kind of everywhere in AI right now. And this Chat GPT thing, in my opinion, for investors, is just a distraction.
Yeah, and here I want to clarify this. If you're listening, like, AI is everywhere. Like Brandon's giving you examples of what they're talking. It's not new. It's been around for years and years and years. But we use it and we give the artificial intelligence very strict boundaries, and we say, I need you to solve all these formulas and run all these theoretical tests for me because you could do it in 5 minutes and it would take me 3 months. And so we use it in that way, and we have very strict boundaries that they work in, and the computer program cannot go outside those boundaries. What they're talking about is we keep loosening these boundaries, and then things like that. You're a threat to my security, or those two AIs that started that they were playing. Was it chess or something with each other and talking to each other?
Yeah, and they actually they developed strategies that humans had never thought of.
Right. They developed chess strategies, and then they started talking, and they created their own language because they realized people were listening, humans were listening to them, and so they had to shut them down. So this is we've AI's been around a while, and we're playing around with it, but we keep it on very tight boundaries to where we can pull the plug very quickly if need be. So we have not let loose anything yet. Even this chat AI is not being let loose. There's very strict boundaries around it. So yeah.
What if the unidentified objects are being flown around by some sort of sentient AI?
Thank you. This is not a conspiracy theory. This is stock and investment news, Brandon. How would we make money off of that?
Could it be? I don't know.
Anyways, so that was Google. That's Google there. I think it's a buy. You think it's a buy. You did buy more.
Cool.
I don't know
I
if
bought
you bought
more
more just to spite Jim Cramer, or if you actually believed in it, but I believe in it. So there you go.
Listen, there's a lot of concerns of the antitrust accusations by the Justice Department or whoever's investigating them. And the government has been fairly vocal about wanting to split big tech up. They wanted to split Microsoft up in 2000. There was actually a court ruling that mandated Microsoft to be split up, but somehow or whatever, I think Microsoft they wound up appealing that, and it never happened. And I think Microsoft in 2000 had much more of a monopoly, if you want to call it that, in 2000 than Google does now. And so you can kind of use this whole thing that, Bing is an up and coming competitor, but that's also the argument that Google will make in courts if the government tries to split them up, that no, they're not a monopoly. Look what's happening with Bing right now.
Apple Safari.
Yeah.
Why is that not being looked at as a competitor or mentioned? Why is Apple not being a monopoly?
It's a competitor to Google Chrome for sure. So right. I mean, yeah, I don't think there's much of an argument to say that it's a monopoly, especially if you're on the other hand going to sit there and say that Microsoft Bing's a big competitor taking market share away right now. You can't make both arguments at the same time. It just doesn't make any sense.
Neither does this economy right now. All right, what do you got next, man? What do you got next?
So Cisco reported earnings and adjusted earnings of 88 cents a share. Revenue was $13.6 billion. And this flew past the 85-cent expectations of 85. It was 85 cents per share. That was the expectation, and $13.42 billion estimate. So beat on top line, beat on bottom line, pretty good quarter. Sales rose 7% in the last quarter. Not many companies that can say that right now. And they raised their fiscal year profit forecast to a range of $3.73 a share to $3.78 per share. And it expects sales growth of 11 to 13%. So not many companies reporting earnings like that, where they're upping their profit forecast and beating on both the top and bottom line and having a 7% sales increase. That's awesome. Cisco is expecting modest growth. $3.36 was the earnings per share for last year. Full year 2022 earnings are expected to increase about $3 to $3.55. So modest growth here, but still it's growth in tech. I mean, what else can you ask for? And they also raised their quarterly dividend only by a penny to 39 cents per share. But when you consider this is the 12th consecutive year of dividend increases, you start to look at this as a pretty safe stock. 3.2% yield is nothing to bat an eye at either.
So I'm happy to see that Cisco or stock is actually moving off of good earnings news and good forecasts. I followed the stock for a long time, and for up until the past 2 years, every time they had a good earnings report, their stock would drop, and I'm just like, I don't get it. But happy to see it moving forward. This is a strong company. They're involved in all kinds of aspects of everywhere in our day-to-day business and life. I will say, when I was reading some of the stuff on Cisco, Brandon, it was mentioning that the good forecast is really because has a lot to do with they have no supply chain worries going forward, that they fixed all their issues that they've had, and that their supply chain is strong. Do you see that as the catalyst, the tailwind here?
Yeah, that's part of it. And the CEO mentioned that as well, that they've got, a lot of their backlog out now. So that was a big part of that 7% increase as well. But let's just talk about the fact that Cisco is a part of the solution to supply chain issues for many industries, and that's also a big tailwind for them, even now. So,
Gotcha. So you see even more growth. You believe in this for guidance. You see more growth going forward. Would you buy this stock right now? It's up 8% after hours.
Oh man, I don't know. It's it tends to the stock. This stock tends to just kind of like float in the exact same space, and then it'll pop out of it and then come right back down to it, like you said, for years and years and years. But this could be a situation where you picked a company that's got incredibly intelligent and capable management. Some of the smartest people in tech are running this company, and they don't get the recognition that they deserve for it. So yeah, I think you can buy this company. You don't expect rocketed growth. This isn't an Amazon. It's not Tesla or anything like that. It's old head tech, right? So
old head tech.
Yeah, that's what it is. Old head tech. It's kind of like Dow Chemical, but in tech.
You say that and it has like this bad connotation because tech, you want youth and young and energy, but yet when you go into any major company and you go into their server room, you have Cisco servers and you have Cisco connectivity devices and Cisco wires and lines, and it's just all Cisco.
Yeah, I agree, yep. And I think, and it's stable. So if you want to put some stability and stable growth in your portfolio, I'm fine with it for sure.
There you go, man. There you go. All right, can we switch gears? I know you have more. But can we switch gears and go to something I have?
Here's the thing. Let's do what you have to do, and then let's see where we're at on the show, because what I have, I think, is actually going to intertwine with your stuff anyways.
Okay. So I'm going to start with the biggest one I have. And it's going to talk about U.S. retail sales, guys, U.S. retail sales. So the retail sales numbers came up, and there's a lot of headlines. So it says, one headline says retail sales jumped 3% in January, smashing expectations despite inflation increase. Another headline says U.S. retail sales roar back. Manufacturing shows improvement. Right? So you would think, okay, sales are looking awesome here, and this is a great opportunity. This means we have a strong economy. Maybe we're not going to get a recession. Well, hold on. Because here's the thing here, man. And so I'm going to read a quote by Christopher Rupke, chief economist at FWD Bonds in New York, because I like what he says here. And he says, every day the economy does not lose steam, the risks go up astronomically that the Fed will lose patience and make those recession forecasts a reality by jacking up rates too high. There is no roadmap for the central bank seeing data like this. That is a quote from this gentleman there, and I think that's a good quote. But I think he's going to a hyperbole on purpose here. But it's still, I think it holds true that when the Fed is looking here and they see inflation numbers go up over 3%, they're like, okay, we're not slowing down. Inflation is at 6.4%. It's not coming down. It went up. We need to raise rates. So that I think the Fed might go back up to a 50, 75 basis points on the next time they raise rates, which is gonna, if that doesn't slow down the economy, I don't know what is. Brandon, thoughts on that real quick? I have more, but thoughts on what I just covered so far.
No matter what, even if it is a soft landing somehow, it's still not good for the stock market to have interest rates go up that high. And to continuously go up that high. My other thought on this is that you often see, I think it's about a 6-month lag between the Federal Reserve raising interest rates and the effects on the economy being shown to us. So we're still not really seeing what the effects of these increased interest rates are. So if they continue on this path of high interest rates, they may go too high on it. They may. And I'm not saying that they're too high, because I really don't know. I think that the free market should be deciding all this, not some maestro at the Federal Reserve raising and lowering and raising and lowering and raising and lowering. But if they don't nail it on the head, man, there's some bad consequences that can happen.
Right, exactly. And so let's look at these retail sales numbers, right? Here's something from Bank of America and their credit and debit card data. It suggested that the lower income consumers are pressured, but they still have solid cash buffers and borrowing capacity. So I don't like them coming out and saying this, because let's say these lower income people have a $2,000 credit line on a credit card. Yeah, they've only used up 1,500 of it, and they're like, well, they still have some borrowing capacity. Yeah, but you've used up 1,500 of your $2,000 limit. You have borrowing capacity, yeah, but you don't want to use that. That should be saved. I don't understand why that's looked at as a good point here when I'm reading these articles about the retail numbers. Anyways, besides that, the biggest jump in retail sales came from food services and drinking places. So restaurants and bars had the biggest jump of 7.2%. So that's where most of this jump is coming from, because they're considered retail. So I know when most people hear retail, they're thinking, oh, Walmart, Target, malls. No, it's restaurants and bars are what's pushing this number higher right now. And it's also January, people. There's not a whole lot going on in most of the cities in America, unless you're in like a New York or San Diego or LA. And so, a lot of Americans will go and spend their money at bars and restaurants during this time. But here's another point here's where I'm going to break it down in a very simplistic, I'm probably overgeneralizing, but a very simplistic way to make it easy for every single person to understand, right? So let's say I own a retail store and I have these dollar products I sell for $1, right? Mm-hmm. And I sell 1 million of them, so I make $1 million revenue, right? Well, inflation's at 6.4%. So I got to keep up with that for my cost wise, because I still got to make money. So I raised my costs 6%. So now instead of $1, you're paying $6 for the same product. And now my retail numbers, I show my top line at 1,060,000. Now it looks like my retail numbers have jumped up, but have they really jumped up, or am I still selling the same amount of goods and I'm just keeping up with inflation? I make that very simplistic and probably overgeneralized example to give you some thought here, when inflation is still running so high, that are we really seeing retail sales jump up, or is this just the cost of items and we're looking at these numbers of revenue and income and they're just inflated because of inflation?
Yeah, and this is why I think it was last year sometime when I said, when you're going into this year, you really need to pay attention to the net margin. And when we were talking about retailers like Target, for example, that have net margins somewhere around 2% or even lower, I think net margins for Target at one point went actually negative for a little bit. So that's what you really need to be looking at. What are they making after all of their costs of raw materials and shipping and labor? What are they making after all of that's taken out?
Right. I mean, what is their EBITDA? What are these? So all these things that we talk about in the show, guys, this is when it's important. It's when it's important to research and read these reports and see what is your net income, what is your gross margin, what is your net margin, what is your EBITDA? We want to know these things because we want to know how healthy is your company really. Because you may have had a 3% jump in total top line number, but is it really a 3% jump, or is now your net? Because Target, when their net margin went negative, their revenue went up.
Yeah.
So I mean, their revenue went up, their top line went up, but they weren't making any money. They were losing money.
When we first started the show, I was paying a lot of attention to gross margin, and I was maybe glancing at net margin because inflation was so high that if the gross margin was high, then the company was fine. They were making a lot of money. But now, like, I'm glancing at gross margin. Yeah, it's above 40%.
You mean net margin? Yeah.
No, I'm glancing at gross margin right now, staring at net margin and analyzing that versus the peers. Because it is the most important part of a business's key performance indicators right now.
Right. Exactly. And, so I question all these, right? So, all right. So in addition, I'm going to read some more things from these articles here, some highlights of these articles. In addition to credit card debt, retail sales were also likely supported by the biggest cost of living adjustment since 1981 for more than 65 million Social Security beneficiaries, which came into effect in January. So several states also raised their minimum wage. They're saying that this had a big part into it. I think it did not have as big as part as the credit card debt because there's so many things on here and all these articles that I've been reading about credit card debt going up, but they still haven't used all their available capital. Their consumers still have available capital left. I'm like, yeah, but guys, they're using credit card debt. They're going into debt in order to continue going out to eat and order their drinks and, buy some retail goods. And I don't see that as a healthy economy. I see some debt as healthy, but
And at some point in the next year, those people are going to face normal. What's the best way to put it? Depreciation costs. Like, I had to fix my furnace last week, and that was crazy high, much higher than it's ever been because of the material costs. And you know what the my furnace guy said to me? He was like, "Yeah, I'm charging more, but I'm making less." He's making less now than he has in the past 10 years because his costs have gone way up and we're paying him a lot more, right? But he's not making as much money.
And people don't realize that, and it's going to hit once they have to go turn around and make these payments or the bills, or they get behind on the loan or something, and then they're going to realize that, hey, I actually need to re-look at my budget here and figure some things out. So
yeah, I'm going to make a repeat joke here, but whatever. Some people probably haven't heard it. Dave, I haven't been going to the gym with you. I'm not getting any stronger, but I can carry 150 pounds or $150 of groceries in one trip.
Yeah, because it's like one bag now, right?
Yeah.
It's ridiculous. But so that's retail sales, guys. That's my thought on retail sales. So most of last year I was really bearish on retail. I'm still bearish on retail. I don't like investing in retail unless I think there's a sure thing. I would just stay away for right now. Personally, that's just my personal opinion. I know Brandon has invested off and on with retail. So
selectively.
Yeah, selectively. And so it's I would say just do your research, look into the numbers and make sure that if you are looking at a retail company that it's definitely one that you want to invest in. All right. All right, so I want to bring up one other thing really quick. I'll try to make this a 3-minute conversation here, if I can. So last week I had made the call very, very irrationally, just kind of off the spur of the cuff there about Blink, and sure enough, as soon as I make a call on something, what does it do? It goes down. It's just that's my typical. I'm used to it, so that's why I always try to DCA. But Blink went down, and Blink went down to about a little under $11 at its lowest when I saw it. After I first made the call, it actually went up right away the very next day for a little bit. I probably could have took a 1% to 2% gain, but I was thinking higher. But it went down about a little above $10 a share. And it's gone. And at that point, when it was around $10 a share, I actually was looking at options for Blink, and I never buy options unless I'm 100% confident in the company. And I knew there was news going to be coming out from the administration more about these chargers and EV chargers, because that's been a big, huge point of why we can't get electric vehicles to be sold more, because there's not enough chargers among the interstate routes and the interstate system. And so we need to have more chargers. So, they come out with a number of different announcements over the past few days, and Blink has gone up. Now, when I was looking at the options, unfortunately, I don't manage my accounts that well. Brandon, I'm not the smartest guy alive. I don't know how I made it this far, but the account that I have that I do options in was fully invested in my long-term investments, and I didn't have any spare cash in that account. And I was looking at the options, and I wish I would have sold something and bought, because the option that I was looking at did double. If I would have bought it yesterday and sold it today, I would have doubled my money in one day, and that would have been very nice. But I bring this up as these are things I look at, and these are things I judge the stock by. And I still think Blink is good long-term as a stock, So I'm holding it. I bought it on our podcast last week, and I'm just holding it right now. I'm not adding to it. It's so close within range of where I bought it that I'm not going to add to it unless it dropped down to like 10 flat. Then I might look at adding some more to it. But right now, where it's at, I'm just holding it. Expecting it to go up and make some money off this. This probably, Brandon, to be honest, would be one I would look at options again on it if it dropped some more, depending on the drop. If it's a market drop because the overall market is finally dropping and the Fed announced a 100 basis point rate, then I would say no. Let's hold off on the options and look for more news and more reasons behind it if it was that kind of drop. But just a normal move downward, profit taking, that kind of thing, then I would look at maybe doing options again on Blink. I don't know. And if I do this time, I will post it on Instagram that I'm going to do the options. So if you followed us on Instagram, you'll see a post about it, and I'll do it there.
Okay.
So, Brandon, I just wanted to cover those two things real quick. So I know you had a few more things. So back to you, man.
If you're really going to get into options and stuff like that, I recommend that you know what you're doing. You understand the Greeks behind the options, delta, theta, all that stuff. Understand what price momentum can do to an option and how much money you can make or lose. If you were playing options yesterday and you had a put on the S&P 500, you would have been in the company of some very intelligent investors, because JP Morgan's trading desk, they said that if the CPI came out anywhere between 6.4% and 6.5%, that the S&P 500 would lose 1.5 to maybe even 2% for the day. And it didn't happen. We got the 6.4%. But we wound up, I think, like half a percentage point at the end of the day. And that sounds small, but if you're playing options, you could really lose your shirt just on that amount. So you need to be careful. Look at your break evens, look at what you're actually paying for the option, and make sure it makes sense.
I agree. And I actually probably would have been along the same viewpoint as those very smart persons about the S&P and seeing that inflation number.
Yeah, you could have like an intelligent idea as to what's supposed to happen, but if it doesn't happen, you still lose money, right?
Right.
1.5 to 2% could still be coming, that could happen down the road. But if you don't get the timing right on it, then it doesn't matter, especially in options. That's, one of the reasons why now, if you look back at Meta, I first bought Meta at or initially around $200. But I made conviction buys and cost average down to somewhere in the low 140s prior to this increase that it's had over the past 3 months. So, I mean, and then conviction, even at $100 when Jim Cramer was crying over it, I was down like 35% on it, somewhere around there. So, but I knew what I had, and I knew I had value. Now, if I would have been playing options on it, I would have been right on the idea, but I would have had the timing wrong, So that's the luxury of owning stocks versus options. But if you're playing options on something, you can protect yourself against some losses if you do it right, But then you can also utilize options as a tool to make more money in the short term when you see something that's a no-brainer, like Dave. He'll detect Blink, and he's probably not going to do it unless he's like pretty, for sure that it's going to happen. But as far as the CPI goes, going up to 6.4%, we've already talked about the fact that it's not good for markets. It's not good for the economy. It's symbolic of a flaming hot economy right now, which sounds great to everybody until you realize that, like, the idea is to cool this down so that we don't have expenditures so high, so we don't have we don't have to go to the store and pay $10 for a loaf of bread. That's what we're battling right now, trying to keep a lid on that stuff. And the higher inflation stays, the larger the tools the Fed has to throw at it, and the more of an opportunity we have for a recession in the near term future. So I kind of did a long way around that.
Yeah, I mean, there's nothing more for me to add. You covered everything. So
somehow I went from Meta to the inflation report, but
It's always back to inflation right now. It seems like, and the Fed.
Yeah, but hey, listen, if we've got a recession coming up, that's going to be opportunity. I'm still long-term bullish on the American economy, and I still think, hey, let's define long-term right now, because we say long-term on this podcast a lot, and the way that I'm using long-term, let's say 5 or more years. If that's your time frame, 5 or more years, Bang is fine to be in right now. But you're going to have to hold your nose if there's a potential recession. You're going to, with any stock, you'll have to do this, but probably more with Fang or any high, growth tech stocks. You'll have to hold your nose. But if you're 5 years out, then what does it matter what happens in the next 3 months?
Right. Yeah. If you are 5 years out, it doesn't matter about 3 months. 5 years. Wow. That is long term. I don't know if my hands can hold something that long.
I'm working on it.
But yeah. No, if that's what you define as long term, then yeah, it doesn't matter. The day to day doesn't matter at all.
Exactly. That's all I got.
Hey, well, I mean that's all we really need, because I was going to talk more about EV chargers, Teslas, and get more into that, but I decided not to. I think we have a well-rounded show right there. Final thoughts, Brandon?
Yeah, what Google might, Alphabet, whatever you want to call it, it might wind up being, a Meta of sorts, like what Meta was last year. And it might have a tough year ahead. It does have the antitrust suits coming at it and stuff like that. Government trying to break it up, which I don't think will happen. But it's what, if you got a long-term investment horizon, then who cares? It's a value right now. We know that people are overreacting, and that it probably shouldn't have dropped 7% after its AI announcement. It's just, I think it's way overdone here, and now's a good entry point.
Yeah, I don't have much to add to that, but I agree. Yeah, go ahead and buy in on Google right now. I think Amazon is still cheap at its prices at right now, even though it's gone up a lot since we started calling it. We started calling on here in the 80s and 90s, and I think Amazon's still cheap. I think Meta's had a good run. I wouldn't get into Meta. I'm looking at Blink and the EV chargers and that whole sector. Tesla's the biggest player there. Blink's a very small player, but I like day trading it, and that's why I keep it on my watch list. Nvidia, guys, if you haven't been paying attention, that stock, I haven't mentioned it in a while, and I said I would quit trading it. I said, no, I'm done with Nvidia. It's always on my watch list. It is over $200 a share again. Do I think it's going to 300? Nah, I don't know. I think we're going to have some downturns in the market. Eventually the Fed raising the rates will have the effect it wants to have on the market. We cannot, because they raise these rates, everybody's costs go up. And so, with costs go up with inflation, costs go up with rates, it's eventually going to have the effect it's intended to, and the market will slow down. The economy will slow down. So it's just a matter of time. So on things like that, stocks that are at 52-year highs, look to see if there's growth. Look at their numbers, check them out, see if there's more growth to come, or if they are at their 52-week high. And we might want to look at, if you're already in them and you're in the long term, hold. Don't buy anymore. Just hold. There's nothing wrong with that. You don't always have to be buying and selling. You don't always have to be. They get that out of your mind right now. That's what I would say. But yeah, if I do make a call on Blink, I will post it on the Instagram. So follow us on the Instagram. You'll see it there. I'll post tonight about the podcast. But overall, good one.
I think the past 10, 12 years, whatever it is, I've been doing investments, I think I've made more money doing nothing.
Something. Yeah, and we'll see that a lot of new investors, they get in this mindset of, I have to make a trade this week, or I have to do a trade right now. I'm like, no, you don't. You don't. You need to wait for the right opportunity. You don't have to be trading every single day.
Right.
Now, if there's opportunities every single day and it just happens to work out that way, great. But if there's not, then you just wait for the right opportunity. That way you don't lose money.
Right.
Patience and discipline is what really works out in the end. But
yep.
All right, guys. As always, we hope we've been entertaining, educational, and uplifting, because we want everyone to make money. Have a good night.
Have a good night.